Welcome back. In this video, we're taking a look at some very interesting research on Palantir stock and fundamentals that you almost certainly haven't seen before. And it's a full factor profile that shows Palantir's fundamentals on a variety of metrics across, all sorts of balance sheet, income statement, and other aspects. And here are some comparable stocks based on the research we're about to look into with the closest factor profiles to Palantir: DoorDash, Monday.com, Tesla, AMD. So not bad company that Palantir is in with respect to these fundamentals. So with that out of the way, let's take a look at what Warren Buffett and many others would think about Palantir based on these metrics. So overall, Palantir has a C rating as of the end of the year for 2023, based on all the metrics we're about to dive into: value investor, Benjamin Graham, Warren Buffett, and so many more. Let's get started. So this report provides a detailed analysis of Palantir based on publicly disclosed methodologies of Wall Street legends. This report utilizes the quantitative strategies of the world's most successful investors: Peter Lynch, Warren Buffett, Benjamin Graham, and many others, based on fundamental analysis and built on core investing principles. Okay, let's get started with the highest score Palantir received based on the Twin Momentum Investor. A score of a 94%, and this style is based on momentum. So let's get a closer look on what this actually means. This strategy looks for stocks with strong fundamentals and price momentum. Fundamental momentum is determined using a combination of 7 variables: earnings, return on equity, return on assets, accrual operating profitability to equity, cash operating profitability to assets, gross profit to assets, and net payout ratio. Price momentum is determined using the most recent 12-month period, excluding the last month. When these two types of momentum were combined together, they've tended to significantly outperform the market. So on the fundamental momentum, Palantir passed this check based on all of those fundamental criteria that I just mentioned. The strategy selects the stocks in the top 20% of the universe based on the metric, and PLTR's fundamental momentum is 3.66%, which places it in the 19th percentile of their database. And the 12-1 momentum says that academic research has indicated that stock momentum tends to persist in the intermediate term, but mean revert in the short term and long term. As a result, this strategy ranks stocks based on their 1-year momentum, excluding the most recent month, and select those in the top 20%. PLTR's 12 months minus 1 return is, of course, 166%. We know it's very high based on its low base coming into this year, which ranks it in the 2nd percentile among stocks in the database. That is amazing. So you combine these two, and Palantir places in the 3rd percentile among stocks in the database, passing all of these metrics. That is really impressive. Next up, we have small cap growth investor based on Motley Fool criteria with a 68% score focused on growth. We're looking for stocks of small, fast-growing companies with solid fundamentals, including healthy profit margins, low debt, ample cash, respectable R&D budgets. A key indicator of a strong stock is an earnings growth rate that is greater to the stock's price to earnings ratio. Wall Street calls this the PEG metric. It's a great way to separate attractively valued growth stocks from those that are overvalued. So first off, we're looking at the profit margin. How does Palantir stack up? Their profit margin of 7.24 passes the test, looking for a minimum trailing 12-month after-tax profit margin of 7%. They're looking for companies whose relative strength is 90 or above, that have outperformed 90% or more of the market over the past year. PLTR has a relative strength of 97 and satisfies the test. Now, the reason Palantir didn't score higher on this and scored in the 60s is because it failed this test. Compare sales and EPS growth to the same period last year. Companies must demonstrate both revenue and net income growth of at least 25% as compared to the prior year. These growth rates give you the dynamic companies that you are looking for. So it says here Palantir's EPS declined significantly, but this is because actually they flipped from negative to positive. So the calculation doesn't work in that way. So obviously their EPS increased and their sales increased as well. So just taking a closer look at this, that actually looks like a mistake in terms of the calculation. So Palantir would pass this test, and overall would probably be and score much higher based on this criteria. Insider holdings, a pass, and we'll keep going. This indicates the insiders are confident the company will do well. Cash flow from operations. A positive cash flow is typically used for internal expansion, acquisitions, dividend payments. A company that generates rather than consumes cash is in a much better shape to fund such activities on their own rather than needing to borrow funds to do so, which we are well aware of. Palantir's free cash flow of 10 cents per share passes this test. Profit margin consistency. Palantir's profit margin has been consistent or ever increasing over the past 3 years. Yeah, again, using GAAP figures is going to be totally messed up, but they say it passes the test for increasing, at least, from full year profitability. R&D as a percentage of sales. Palantir has reduced their R&D expenditures over the past 2 years, which is unacceptable, it says. Palantir is jeopardizing the future in order to boost current EPS numbers. This criterion is particularly important for high-tech and medical stocks because they're so R&D dependent. So this is a great example of why screening doesn't always work, right? Now you might ask why screening, the technical term for selecting certain criteria that are important for narrowing down a universe of stocks. Why is that necessary? Well, it's necessary because there's so many stocks to choose from. If you're an investment manager, you need to somehow determine some criteria that you want in the stocks that you're going to spend a lot of time on researching before you make investments. So it's important that you're using the right metrics, first of all, and second of all, that the companies that you are analyzing have metrics that are appropriately being represented. So in this case, you wouldn't know that it's actually a good thing Palantir's been reducing their R&D budget. You wouldn't know that without first understanding the company and its story. So you couldn't just tell that from just the numbers, right? You would be concerned, why are they reducing R&D? They probably don't think they're going to do well into the future. They're probably concerned about their product roadmap. They're probably cutting costs. That's going to impact their revenue growth. When all of us know this has been Palantir's goal from when they first went public and had so much stock-based compensation. It's been their goal to reduce it over time. So there's a whole story behind this metric that might look bad on paper that you don't understand if you haven't done the work. Now, why is this a good thing for us? This is a good thing for us because that's an inefficiency in the market. Palantir doesn't always screen well, so to speak. Palantir's numbers don't always look great on paper. Now, that means not as many people see it as a compelling opportunity or one worth digging into up front. Now, that's great for us because it provides opportunity. If all of Palantir's metrics look great on paper, the stock probably wouldn't be undervalued. So that's why I just wanted to say that it's almost a good thing that some of these are incorrect. There's a lot of work that goes into verifying the results and making sure you're interpreting them correctly. Of course, it passes on cash, accounts receivable, long-term debt to equity. We can just skip some of these. I would be interested to know about the PEG ratio, what they're doing here. So it's an extremely important analysis, but Palantir's ratio is not available due to a lack of earnings. So yeah, I mean, again, based on the annual figures, is another example of how you wouldn't really know exactly what's happening unless you're looking on a quarterly basis. But that's going to flip very soon. Average shares outstanding. Palantir has not been significantly increasing the number of shares outstanding within recent years, which is a good sign. Palantir currently has 2.2 billion shares, which means the company is not taking any measures with regards to the number of shares that will dilute or devalue the stock. Okay, so it doesn't screen as a small cap. It's kind of dumb to put that in there, but whatever. Again, an arbitrary limitation on price. So let's just speed through the rest of these. We have the earnings, revision, investor, score of 60%. Palantir has a lot of analyst coverage, but current year estimate revisions, it says companies, it's looking for companies with upward revisions, but Palantir's current EPS estimate is 25 cents per share, and it was 25 cents per share a month ago. So estimate hasn't changed. Interesting that you would fault them for having the same estimate, but again, you could argue any of these. Same thing with next year's. It's been flat. Current year and down revisions. Palantir has had 3 up revisions and 0 down revisions in the past month. Next year, up and down revisions, 2 up revisions and 0 down revisions. So obviously a positive outlook, maybe not significant increases in expectations though. So there you have it. These are the scores overall. We didn't get through all of them because some of them are pretty tedious. And as I learned going through this, not all of them are completely accurate, but I did say, I think that's almost a good thing, right? Palantir screens well on a number of metrics and doesn't on some others. That doesn't mean that's a bad thing for the stock. In fact, I think it represents opportunity, which is great news. And I'd love to see how these metrics continue to evolve over time. I think a lot of them are going to improve as Palantir's fundamentals ultimately improve, and I think that's almost something that we should be looking forward to. So, with that, I'd love to hear your thoughts in the comments. Until next time.